What's up, snipers? I hope all is well with you. I literally had the craziest idea into helping new traders and developing traders into getting down their institutional trading strategy. Now, this institutional trading strategy breakdown will only be broken down into 4 simple steps so you can start hitting the charts and winning trades today. Go ahead and like and subscribe in this video and definitely share to other traders that can definitely benefit from this information, and let's all grow as traders. Let's go ahead and hit the charts. Stay blessed, not stressed, and let's get it. What is up, everybody? Let's go ahead and get into the charts and talk about these 4 basic steps to an institutional trade. All right, guys, this is going to be quite simple. All right, just stay with me and make sure that you guys are paying attention. All right, so you guys can get these 4 steps. All right, I'm going to break down every 4 step, step by step. All right, and make sure that you guys understand this completely. All right, so in this 4 step process, okay, 4 basic steps to institutional trading. Perfect. Perfect. Okay. The first thing that we are going to talk about, number one, all right, is we are going to talk about directional bias, okay, and finding the last leg of impulse. Okay. All right. So guys, finding that last leg of impulse is going to tell us which direction the market is looking to go into, has a chance to go into. All right. Now, when I talk about directional bias, guys, you know, there are 4 market structure patterns that I go ahead and look for. Okay. And these market structure patterns are upside continuations. Okay. What I just drew out here, where you have an impulse correction, and then you have the downside continuation, where you have an impulse, retracement, correction, whatever you want to call it, impulse, retracement, we're continuing to go lower and lower. All right. Then we have a downside reversal where we're going to the upside, but then take out these last lows, retrace, and continue to the downside. Okay. And lastly, we have this reversal to the upside, where we're creating lower lows and lower highs, but then we clear those old lower highs and create a higher high and start to reverse and get into that upside continuation phase. Okay, so I'm going to actually put these into puzzles for you guys real quick so you guys can understand really how this works. All right, so this buying reversal will be like this at the bottom of a trend after we see this sell trend happen. Right, boom. So we have this continuation, then we would have that reversal come down just like this, but we wouldn't have gotten the reversal for the sell if we haven't been on this uptrend here. Okay, so this is exactly how the market will move. We will go in this continuation to the upside. This is just a sketch, guys, so just don't take this too literal. We're going to get into the chart soon. Okay, then we see that reversal where we create this new high, then break that last low, and then get into that reversal structure. Okay, guys. Now, I'm not going to get too much into this, right? If you guys don't know too much about how I trade with market structure, then you need to go ahead and check out my YouTube, scroll down, and find the video that says institutional market structure, breaking down why support and resistance does not work, so you can have a better understanding of how the banks are moving the market and real
market structure tips. Let's go ahead and get into the video.
Alright guys, so now that we're back, okay, finding directional bias is key to getting our trade and getting our entry. Okay, it is very key to finding out which direction the market is going to go into so we can go ahead and get our entry and take the trade in that direction. Okay, so let's go ahead and break this down. Let's take this back here. Okay, let's take this back here. All right, so we can see on this 2-hour structure that this market structure here is showing us that we are going on a downtrend. Okay, the first thing that we want to look at, okay, is where's the last high that created the last low. Okay, so we see that this pushed up, cleared these highs here, basically clearing liquidity. All right, now liquidity is basically just where people's stop losses are. Okay, so just think about this as being support or resistance, or where people's stop losses are, or whatever. Okay, we cleared liquidity, then after we cleared this high, we then pushed and cleared that low. Okay, this shows that this is now that last leg of impulse. Okay, because this is that last leg that created a new lower low because we are on this downtrend. All right, we are on this downtrend. This is that last leg that created a lower low. All right, now we're going to consider this our trading range. Okay, from this high to this low, this is our trading range. Okay, and what I mean by that is we are only looking at price in this range, okay, until price clears this high or clears this low. All right, so just take that in consideration because that will help you start to look at only where you need to look at instead of looking at any other place on the chart that you really don't need to look at. Okay, so now that we understood directional bias, okay, we understood that we cleared this high, then cleared that low. All right, this shows us that we are in this that downside continuation phase. We're starting that downside continuation phase because we cleared out liquidity on both sides. All right, but first we did it at the high, then we did it at the low. All right, wherever you clear liquidity at, second is where the direction is going to go. Okay, so first we cleared it high, and then this impulse leg cleared liquidity at the low. This is what it shows here. Okay, now step 2 into this 4 basic steps of institutional trading. Okay, 2 is quite simple. We are going to draw our fibs. Okay, all right, now guys, if you are not used to how I trade, all right, drawing fibs is going to be very different, I can say, or maybe not very different, but quite different. Okay, so when looking at sales, all right, when looking at this last impulsive leg and we are on that downside continuation, right, we're selling, you're going to go from the high to the low. Okay, so we'll do this here. We have this, this, this. All right, you're going to go from the high to the low. All right, now this is my fib here. All right, you guys can see it, 886, 786, 50%, and then it's negative 2.3. Okay, I don't use anything else. I may go ahead and use a 7-1 occasionally, all right, but not really. Okay, the reason why I use this fib like this is because banks, all right, place orders, okay, in these ranges of 78 to 88% retracement of that leg of impulse. Okay, another video. If you guys haven't understood how the banks move the market, then Alright guys, so now that we're back in the video, these fibs are quite fantastic. Okay, because they give us this premium range or discounted range if we're looking for buys, and I'm gonna explain that right now. Okay, what I mean by premium and discounted range of price, if I want to sell something at a premium price, I get a better price for it. I get a better profit for it. Okay, if I want to buy it at a discounted price, I get a better price to buy it at. Okay, this is how the banks think. They think that, or they do think that this is a premium price to sell at because it's very high. All right, you have a lot of people trading at this 2-3 level right here, 50%, 618, right? But banks are retracing this all the way to 7.8 to 886 and then continuing lower. All right, so now that we're going to go ahead and draw our fibs, okay, we're going to go ahead and draw this from the high to the low. Okay, and now we can see that we need to anticipate price to come to this area around here. Okay, but now I'm gonna give you a little hint. Okay, I'm gonna give you a rule that I follow. All right, I do not sell until I get above old highs, and I do not buy until I get below old lows. All right, this right here is a old high. I'm not selling until we get above that old high right here. So that just means that 786 is now eliminated. I'm only going to take trades above this red line to this one. Okay? So now that we understand our fibs, okay, we understood that this is our premium range of price, and we understand that this is our extension that we are going to target at. All right, and I'm going to explain that in a minute. I'm going to also break down this buying range as well, so you guys can understand that. Okay, when looking for buys on the fib though, you will go ahead and use the low to the high, and you will get it in the exact opposite way than the sell. Okay, perfect. All right, so now we are on to step 2. Okay, I want to break down step 3. Okay, I want to break down step 3 because step 3 is actually where we are mostly going to be getting our entries from. Okay, so now we are going to find the last buy to sell candle or sell to buy candle. Okay, now this is also going to be considered, okay, a institutional candle. All right, you'll hear me say that sometimes. All right, so now when we're looking at these institutional candles, okay, once again, if you do not understand what an institutional candle is, or you don't understand what that, or how banks move and manipulate the market, please make sure you go to my YouTube, scroll down in the videos tab, and go ahead and click into Institutional Basics Part 1, Liquidity, Imbalance, and Structure, so you can understand how institutions and banks are moving and manipulating the market. Let's go ahead and get back into the video. Let's get it. All right, so now that we understand that we need to go get that, all right, we are going to start to flicker through these time frames, okay, and we are going to identify where our last significant buy to sell candle is that has not been retraced into. Okay, and we can say right here. Okay, so we can see right here. Okay, it won't always look this clear. This can be considered the institutional candle, but for today's training, we are going to use this last buying pressure, okay? All right, because this is where the banks are placing their orders to push the market higher, clear liquidity here and here. All right, so these are these buying orders that we're trying to get back to then continue to go down. All right, so this right here, I can make my point of interest here, and then we can also do 50% of this trade of this candle here. Okay, so now this is my entry area that I'm looking for. Okay, I found my last institutional candle. I found my last buy to sell candle that we're really looking for. Okay, let's really look at this on a 2-hour time frame. Okay, perfect. All right. Now that I found my last institutional candle, I can go ahead and place my position tool. I'm going to place my stop loss at the high. I'm going to target the low and the extension, okay? So now let me break this down. 50% TP1 on most occasions. The low is TP2 and then the extension is TP3. Okay, as you can see, now we have our trade set up here. Okay, and now we are going to focus on risk to reward and seeking and destroying price. Alright, when I look at my position tool, I see a number right after it says risk slash reward ratio 10.7. This means for every 1% that I risk, I will get times this number. Okay, so if I risk 1%, I'm going to get 10.7% of my account on this trade, or 2%, 20%, or 0.5% of my account, I'm going to get 5% of my account. Okay, when you focus on risk to reward, okay, I'm going to break this down too right now. Okay, let's actually go ahead and we found that institutional candle, right? This is that last buying pressure. Okay, let's go ahead and get into step 4. Focus on risk to reward, seek and destroy price. Okay, risk to reward is going to be your friend, guys, because you can lose 7 out of 10 trades and still be profitable with trading. Okay, so let's put this into perspective. That's a 1-to-1. Okay, we're going to start off with a 1-to-1. Alright, here we go. 1-to-2, and then a 1-to-3. Okay, so now let's look at this for a second. Okay, this is our 1-to-1. This is our 1-to-2. And then this is our 1-to-3. Okay, let's say that we took 10 trades out of the week, all right, and we only used a 1-to-1 risk reward. Okay, this means that I risk 1% to gain 1%. I risk $5 to get $5. Okay, if I lose 7 trades, I'm losing 7%. If I win 3 trades, I'm gaining 3%. So in reality, I've lost 7% of my account after taking 10 trades because I lost 7 out of 10 trades. Okay? Now, if I had taken a 1 to 2 risk reward, meaning that for every 1%, I'm going to make 2%. For every $5 I make, I'm going to make double that, basically $10. All right. If I lose 7 out of 10 trades, I will really be about minus -1 to -2% of my account. Okay. Now, if I only took trades with a 1 to 3 risk reward and I lost 7 out of 10 trades, I would be in profit by 1%. I would rather be in profit by 1% than be in drawdown 1% or be in drawdown 7% or even be at break even. Risk to reward is a crazy factor that you can leverage in the market to now make way more money than what you have lost. And also doesn't take that much effort to make money now. Okay? So let's delete this. Okay? And let's move on. Okay, let's talk about seeking and destroying price. Alright? Now, let's get our entry first because we did find that last institutional candle here. Okay? We found that was that last buying pressure. Okay, we could have even taken this entry here at this last buy candle here. Okay? And then, boom, we went ahead and cleared these lows here. Okay? Now, what I mean by seek and destroy, we know that liquidity is always below old lows and above old highs, so price is always going to seek and destroy these old lows. So when people think that, oh, we're going to buy at this support here, they're absolutely wrong because banks and institutions are going to seek and destroy liquidity every single time. What's up, snipers? Thank you for watching the 4 basic steps to institutional trading. I actually have a bonus clip for those who watched the whole thing. We're going to call this step 3.5. Let's go ahead and teach you how to go ahead and have better confirmations when trading so you can have a higher probability and a more success rate. Let's go ahead and get it. Well, so 3.5, okay, 3.5. All right, so after you find that institutional candlestick, all right, to get a better confirmation, all right, better confirmation, find reversal candlestick. Okay, pattern. All right, we'll do that. Okay. Now, guys, if you don't know anything about reversal candlestick patterns or anything that I've been talking about candlesticks, then you need to go ahead and check out my YouTube channel. Scroll down to the more recent videos and go to how to use institutional candles to find entries, and you will have a better understanding on how to use candlesticks to confirm your entry. Let's go ahead and get back to the video and let's get it. Right after we've taken that entry and we cleared this last low here, all right, this shows that we are now clearing new lows and making new lower highs to continue to go lower. Okay, we're going to go ahead and go on a smaller time frame. All right, and we are going to go ahead and do the 4 steps on here. Okay, this is that last leg of impulse. You see, this is that last high that created that last low. Okay, we see 886 can give us that entry. All right, we wait for price to get up here. Let's actually draw. This is where that last significant sell to buy candle is here. Boom. Okay, so now this is what I want to show you guys. Okay, so when you're trading like this, okay, let's say that you are trading New York session, right? You're trading for the day, all right, and you don't have any sell limits or buy limits up here, or you're actually watching the chart, okay? There's something that I like to do, okay, and I like to go ahead and wait for price to give me a candlestick pattern, a reversal candlestick pattern that I like before I take the trade. So price can still reach this 886 to 786 range, okay? But I still need a reversal candlestick pattern, okay? And on this 30-minute time frame, I see this evening star pattern here, and then boom, right after that sell candle was formed, I would have waited for that retracement like I did earlier 2 days ago, took that entry, okay, and I would have taken that all the way down low. We have that bearish engulfing there. We also on the 15-minute have another bearish engulfing. I think this is the one that I took. I think I took on yeah. On the 15-minute, this is where I took that entry there. I see that bearish engulfing was formed. Bang. Took that entry, was in complete profit, no drawdown. Okay. Took that entry right here to be realistic. For my stop loss here. Okay. And then I went ahead and target this low here. And that's step 3. That's how you can go ahead and be more secure with your trades. Okay, so you're not guessing and trying to find out if the market is going to go in your direction, if the market is going to hit your entry, and if the market is going to hit your stop loss. Okay, so guys, I just want to say thank you for watching this 4 basic steps to institutional trading. We're here to develop traders into snipers, and we're going to go ahead and make people win. All right, so stay blessed, not stressed. Keep trading, happy trading, and let's grow.